Good evening. Welcome to Africans Talk. My name is Ep2, and today we're going to talk about the interest rates that banks charge you and how those are determined and how you can manage those factors to better the interest rates that you get from the banks. So basically what the banks do is they assess your risk, and based on your risk profile, then they will charge you the interest accordingly. So if you're a high risk client, obviously you're going to get a higher interest rate compared to a low risk client who would then get a lower interest rate. So today we're going to talk about the three things that the banks look at. Obviously these are not exhaustive because there are a number of factors that are taken into consideration. So today we're just going to cover three basic things that the banks look at when determining the interest rate that they charge you. So the first one is your credit rating. So this credit rating is the rating that is given by credit bureaus. So you and I are most welcome to go to these credit bureaus and download our credit report. So TransUnion is one of the credit bureaus that you can go to and download your credit report. So if you have any defaults against you, if you've gone for debt counseling or debt review or anything like that, then that would be reflected there. If you have defaulted on your payments, those are going to be reflected there. So the aim then is to, as much as possible, have a credit report that is clean and does not have any defaults or any judgments against you or things like that that would raise eyebrows with the bank. The second one is your character. So banks look at character to determine if you are a client that is worthy of their loan or their credit. And if you are someone who is of an unstable character or perceived as such, then you will get a higher interest rate. So things that they look at are things like how often you've moved, how many jobs you've had in the past. So if you have like 5 jobs in 3 years, then they see you as someone who is unstable and therefore poses a higher risk and therefore will consider charging you a higher interest rate. So for example, again, if you're someone that moves around, if you've lived in 3 different places, the bank is going to worry about whether they're going to be able to track you down when you don't pay, and they can find your ass and be like, hey, pay up. So if you're someone who is unstable, you move jobs, you move around, then obviously you're going to get now a higher interest rate. Not necessarily, but it's something that will work against you. The third one is collateral. So if you have an asset or you have cash that you can use against that loan. So if you can put a deposit on your car, if you can put a deposit on your bond, or if you've got assets, maybe you've got jewelry or you've got some sort of machinery, the bank has some sort of asset that they can claim and sell to pay back the debt. So as much as possible, try and gather these assets that are worth something and therefore lowering your interest rate. So we're going to recap the 3 things that the banks look at in determining your interest rate. Number 1 is your credit history, your credit rating. This you can get from any credit bureau. Once a year you are free to get a free credit report. Number 2 is your character. How often do you move? How many jobs you have? What job do you do? Number 3, collateral, assets, things that the bank can claim to pay back the loan if you are unable to. So this is myself, Ndebo, signing out for Africans Talk.